Okay, Winnie, I think let's get cracking on this one. More people are joining. I can introduce JB Solong. So good morning, everyone. Our quarterly investment webinar this morning. We have two guests again this morning, the one being JB from Sequoia Capital, and then we have Jaco van Tonder, that is part of 91. Now, JB is going to be our first speaker. Now, obviously, a lot of you have met JB before, have heard him speak. Just something about Sequoia and what they do and why they are such a close partner with NMG in our journey towards financial freedom for our clients is that Sequoia is what we call a DFM, a discretionary fund manager. Now, how I always describe it to our clients is that if we sit with a member, our objective as a financial planner is to work on strategy with the client, work on tax, work on execution, and making sure everything happens in the background. And then we go and, based on the client's portfolio and needs, say these are the funds that we suggest and the asset allocation that we suggest should be in those portfolios. Now, where JB and his team comes in, there are over 1,700 unit trust portfolios, let alone private equity or other type of investment opportunities out there. And as a financial planner, there is no way we can go and do a due diligence on each and every one of those funds, those companies, and give advice in the process. So that is why we need a team of researchers behind us, and not just go and say, oh, this is a nice pick of a fund, we want to use this fund or this fund, but actually someone that has the knowledge, competencies, and the systems and processes to go and evaluate, vet, and make sure the investments that we put into our portfolios for our clients are actually based on our clients' needs and will meet the litmus test and make sure that clients can actually achieve their financial goals towards retirement and financial freedom. So that's just a little bit about JB and his team. And Sequoia, incredible team. We've been journeying with him. And I think that the journey with him has been quite successful, and our clients are seeing and reaping the rewards of it. So, JB, thank you very much for joining us again today. Were you going to give us a little bit of market update of what's happening currently out there, and the things that you are seeing as a fund manager?
Morning. Thank you, Stian, and good morning to everybody listening. It's always nice to be part of this session, and just to provide a bit of feedback of what's going on in the market. It has been a busy time for us in the markets, and Stian, you rightly said that there's over 1,700 unit trust funds currently available for sale in South Africa. Now, to put it into context, there's 1,700 unit trust funds, and there's only about 300 odd listed companies on the JSE. And of those 300 listed shares, probably about a half of them are actually investable. So that universe is actually a lot less than you think, and hence the need for someone like Sequoia Capital to provide assistance to advisors and ultimately the benefit of the client. So in my slide deck today, I want to touch on a couple of things. The first one is I just want to give an overview of what's happening in the markets by looking at some economic touch points. Then I'll just provide a quick overview of what did happen in markets performance-wise. But then it's also important to get an understanding of how do we view markets valuation-wise and how does that fit into portfolios. And then I'll just end off with just showing what our current positioning is in the portfolios. So if I can start off with just a recap. A lot has happened this year so far, not only in the second half of this year. So, and I've put up some key elements. We are in a phase of the market, a phase of the cycle where a lot of the market movement is driven by economic data. We are in a cycle where interest rates have hopefully peaked now. We're starting to move down, and inflation has also peaked, and we're moving down. So we did see the U.S. Federal Reserve Board at the previous rate meeting in June decided not to hike, and then subsequently in July we did receive a further interest rate hike. I read a comment this morning from last night's FMOC meeting minutes. So that's the Federal Open Market Committee. So it's like our MPC committee. They released the meeting minutes of the July meeting, and it seems to them that they don't foresee us going into well, the US, not us, the US going into a recession um, in the next 12 months. But that's also always open for debate. So we also had our inflation locally, which has peaked at 7.8%, and it's trending lower. But although I think our inflation is trending lower, there are some worrying signals in our inflation, more for the consumer. If you look at food prices are still highly elevated at about 11%. That's something that touches the pockets of every investor. Then the rand has been having quite a volatile bit. If you look at just the second quarter, or from April to June, we touched a high of 19 rand 73. That came down to about 17.49, and as we are today, it actually went up again to about 19.15. The last time I looked this morning. I did touch on the US recession, so that's always fading. And we've seen a bout of good economic data in the US. Locally, we did see that we kept our interest rate unchanged at 8.25%. So I think going forward, the expectation is that our interest rate decision will be highly influenced by the movement in our currency. There's a notion that we only think our Reserve Bank looks at inflation data, but they're also keenly aware of what's happening in our exchange rate, and an exchange rate that weakens too much can have a devastating effect on your inflation rate. If I can use Argentina as an example, 2 days ago, the Argentinian central bank increased their interest rates by a whopping, I think it was 21% in one day. And that's in the back of the Argentina peso that devalued quite aggressively, and the inflation is expected also to pop. So inflation for emerging market, your interest rate does have an impact on the decision of the South African Reserve Bank. Luckily, our Reserve Bank has been ahead of the curve, meaning they have actually hiked more than what the developed market counterparts did. You would recall that we actually had 50 basis point hikes this year and not 2025. Then China is also quite an important touching point for the past quarter. We all expected China to reopen after COVID, and that reopening to be quite aggressive and to assist the economy, and that all fell flat. That didn't happen. And if you look at the reasons why, if you look what happened in the West, not only in the US but also in South Africa, is that the government supported the consumer by giving the consumer money, and the consumer either spent that money, or in the US spend it, but also build up huge stockpiles of savings. In China, the Chinese government did not support the consumer. They essentially supported companies. So there's that lack of consumer spending that's actually showing now in this weaker Chinese data, manufacturing data. Then lastly, it's load shedding. No presentation is complete without mentioning load shedding. We have been experiencing load shedding in SA, as always. It has tapered down, so we're currently sitting about stage 1 to stage 3. But what we don't know is what the general public knows, that we are burning billions and billions rands worth of diesel to keep the lights on. So that's also not good for the Eskom scenario. If I can touch on recession and growth, and I show there two charts. And I like to speak of charts because you can relate to what I'm saying when you're looking at these charts. So the chart on the left-hand side is the probability that the US market is going to go into a recession over the next 12 months. Now, there are three lines. The dark blue line is essentially the Bloomberg forecast. So you can see it actually ticked up, and now it's turning down a bit. And the light blue line is the market implied. That's what the market thinks. And then the orange dot is Goldman Sachs, which is one of our research providers. So there is a lower probability of US entering a recession. Essentially, it's been ticking down. I saw a research piece this morning where they said that over the past quarter, a lot of companies didn't mention the word recession into their investor feedbacks. So a lot of the companies are starting to price in maybe that a recession might be not forthcoming, or that it be less severe than what is expected. Now, the question you might ask is, why is this happening? And this is this chart on the right-hand side. So this essentially is the amount of savings that was built up in the US market by the US consumers. You can see in the COVID era, the amount of accumulated household savings that has built up. And these accumulated savings, so this is the absolute amount, and this black line, essentially the cumulative savings. So there's still a lot of cumulative savings penned up in the US market, the consumer market. Remember, US is quite a heavy consumer-driven market. And this is the reason why the recession has been, it's kind of like kicking a can down the road. We're just kicking it down the road, down the road. It's because of these pent-up savings that's still sitting in the US market. Another big talking point, obviously, is interest rates, because interest rates do drive a lot in the markets. And I do provide a chart here with rate expectations, but that's less important than the two other charts that I show. So let's maybe focus on the one on the right-hand side, this one. This is the US market. And black line essentially is the US interest rates. Now, the important thing to notice of this chart is there's three other lines, a blue, green, and a red line, and a gray line. And if we take one point in time, so we take, this looks like about September, August in 2022. So at that point in time, the market expected that by this time, which is just close to there, the Fed would have stopped hiking rates, and we would have started pricing in rate decreases. But in actual fact, what happened is the Fed kept on hiking, so the market mispriced it. And it's the same with all the other lines, and that's been causing a lot of volatility in markets. It's this disconnect between the message that the Fed is giving and what the market is pricing in, and that's caused a lot of volatility. So each time that there's an economic variable that comes out, that's either negative or positive, the market has this knee-jerk reaction, either up or down. And it's because of this phenomenon. Now, the smaller chart on the bottom here, bottom left, that is the South African interest rates. So you can see our rates coming down, then our rates moving up. And we had a similar phenomena. So we had a similar phenomena in the beginning, where the market didn't price our interest rates correctly. But as you can see, the last one there is our market is starting to price our interest rate expectation a bit more accurate. Then the big one is the rand. South Africans love to talk about the rand, and the rand is actually tied also to our emotional well-being. Whenever the rand blows up, we all want to take our money offshore, not only a little bit, everything. And I think in Yaku's presentation, he's going to touch on this, the fact that offshore investments versus the money you draw when you retire. But just turning back to all these charts, so the bottom one is just illustrating the light blue one is the fair value of the rand. That's where the rand should be trading right now. So you can see, and we're currently sitting about there. So the rand is completely overvalued, undervalued. So it's blown out completely, and we all know that. But the one thing that I want to focus on is that we South Africans have got the ability to internalize the movement of the rand, meaning whenever the rand moves like it did now, we kind of search internally for problems, and we want to attribute a rand weakness to internal problems. And yes, we do have internal problems. We're going into election year. It's always a lot of promises and under delivery by the authorities. But we need to realize that we are emerging market, we're open market, and our currency, the rand, is highly influenced by the movement in the dollar. That's what I want to illustrate with the bottom left chart. So it's only for the past 6 months, and the blue line essentially is the US dollar index, and the green line is the rand dollar exchange rate. So you can see how correlated these two are. When the dollar strengthens, the rand weakens. When the dollar index moves down, the rand actually appreciates. Again, same there. But so whenever we see the rand move, it's always good to understand what the dollars do, because we are influenced by the dollar. But there are instances where that movement, that correlation doesn't hold. And this is this red circle, which I've actually blown up on the right-hand side. So here you can see the dollar essentially strengthened. So you would expect the dollar to weaken, but the rand actually strengthened. And this was on the 24th of July. And this was due to one specific event. The Chinese Politburo had a meeting on the morning of the 24th of July. And the Politburo meeting is basically the central committee of the Chinese government that sets policy. they came out, and the news that provided the market was extremely positive. The Shanghai index was up about 3.9% that morning, and all commodity exporting currencies did this. It strengthened. So it's important when you're looking at the currency to realize that it's not always attributable to what's happening internally. Now, that means that whenever the dollar should weaken, whenever this index should weaken, the expectation is that the rand could strengthen. The magnitude of the strengthening would always depend on what's happening internally. So it's important to understand when you invest in offshore, the amount you're investing offshore should be optimized. It should be the correct amount. They're not chasing everything offshore just because the rand has depreciated and everything's burning locally, because the movement of the rand isn't always attributable to what's happening locally. So what has happened in the markets? And I've got two charts here. If you focus on the first one, it says first half of 2023, so that's 6 months until the end of June. It's the global offshore indices and the local indices, and the local ones are in rands, and then obviously the offshore ones are in dollars. So you can see our offshore index being up almost 6% for the year so far, and that's been driven by industrial shares and financial shares. Obviously, industrial shares being the edge is heavily influenced by the movement of the rand. So the rand weakened 11% over this time. And you can see a lot of returns came from the offshore market. The World Equity Index, which is the MECI index, was up almost 14%, but the mammoth one was the Nasdaq index, up 40% for the year so far in dollar terms. Now, if you look at the S&P 500, it's only up 16%. There's quite a specific reason why the Nasdaq index was up this amount. But I want to highlight one thing about this index. The bonds in global bonds was basically flat for the year, but global equities was up 14%, and that's a bit of a worrying sign for us, because normally you would find when equities are up, your bond market would also be up. And so what we're inferring from this is that markets are expecting that future company profits would be stronger than expected. Hence, that's why we're keeping quite a watchful eye on not only earnings, profits of companies for the third quarter, but also the fourth quarter of this year and the first quarter of that year. Because if that starts to disappoint, one could expect that the emerging markets will just pull back a bit. And also, if you look at what happened, and also means the tale of two halves. So we've got a scenario where for some indices, the first half was better than the second. So if you look at the all share index, the first half of the year was actually better than the second half. The second half, the all share was basically flat. This is the reason why that Nasdaq did so tremendously well. It's because of the phenomenon which is called AI, artificial intelligence. So if you look at the S&P 500 index, the chart here on the left, the S&P was up about 15% in dollar terms when this chart was drawn. But the 7 biggest technology companies in the index, and it's Meta, which is Facebook, Amazon, Apple, Microsoft, Google, Tesla, and Nvidia, they were up a mammoth 58% over the same time period. So that essentially means the remaining 493 companies in the S&P 500 index is only up 4%. Now, if you have a look at the chart on the right-hand side, it's for the first quarter of last year versus the first quarter of this year. That's the amount of times that in the company's shareholder meetings, they mentioned the word AI. You can see how this has just ballooned for this year. And this is one of the big drivers of the returns in the Nasdaq. It's the expectation that artificial intelligence, the use of artificial intelligence will actually improve profitability for these companies without actually having a meaningful increase in costs. Then, just moving on to the next phase of my slide deck is how do we look at market valuation? How do you determine if a market is expensive or cheap? How do you know if the all share index is expensive or cheap, or the S&P 500 is expensive or cheap? And so we look at it on a simplistic basis. We look at a ratio called the PE ratio, the price earnings ratio, and that's basically the price of the share divided by its earnings. Now, earnings is the profits of the share. That gives you a ratio. Now, how you use that ratio is that you compare it either against the stock itself, so it's its historic price earnings ratio, or against its competitors, and not only in stock but also markets. You look at the all share, the all shares historic price earnings ratio, and also the all share compared to other equity markets. Now, if that price earnings ratio is lower, the current one is lower than its historic one, or lower than its competitors, it means our market is cheap. If it's higher than that of our competitors or its history, then it's expensive. But when you do use a ratio like this, you need to understand that on the short-term basis, it doesn't provide any meaningful insight. It's only on a long-term basis that it actually is of value. This is these two charts. So you can see the first one here that I'm circling. That shows you that in the short term, so this 1 year, it's research done by JP Morgan, that over a subsequent 1 year, that price earnings didn't tell you anything. So the level in which you're buying doesn't indicate whether you're going to have a good future performance or not. But if you look at a 10-year basis, you can see depending on where you are. So if it's cheap, if it's there, it's cheap, then you see then your future returns, longer term returns are much better. Where if you're expensive, you're sitting here, you can see your future long-term returns are not that well. So this is why we look at valuations, but we supplement the valuations by looking at the business cycle, at market cycles, understanding how we can position a portfolio in the short term to maximize the returns for investors. If we quickly look at market valuations, so this is all the world equity markets. It's essentially what I just said. It's a price earnings ratio. So the purple line is essentially the average, the long-term average of this market. So if you look at the US market, its long-term average for the S&P 500 is sitting at 90. So it's slightly expensive. You look at Japan, the Japanese equity market, essentially below that purple line. So that's essentially a bit cheaper. The same for Europe, a bit cheaper. Emerging markets as a whole is, let's call it, fairly valid. And then China is still on the cheaper side. So, and again, if you look on the right-hand side, this is the all-share index, just a different type of chart. So the red line is the long-term average, and this is forward-looking price earnings. So that's taking into account next year's profits of companies. You can see that that's the average line, and we're sitting here. So we're also on the cheaper side. So if you look at this, you kind of really tell yourself, where should I be allocated a little bit more of my money? Then if you look at the positioning of the portfolios, we normally, well, every portfolio we manage has got something called a strategic asset allocation. And this is these two bars on the right. So what essentially it says, and I'm going to use the balanced portfolio as an example, it says that over the long term, you want to be allocated 46% to SA equities, 15% to SA bonds, 5% to SA income, 22% to global equities, and 2% to global bonds and global cash. And that's the long-term outlook. Now, we would look at those valuations and also the current market cycle, macroeconomic data, the business cycle, and determine how we can slightly adjust these. And this essentially is what we call this chart. So neutral would be these amounts. Being slightly underweight, like in the case of SA equities, being slightly underweight means we're going to probably sit there. And that's about 40%. So we're going to be about 40% in SA equities. So if you look at the positioning, and it's always done in the context of these numbers, we're slightly underweight SA equities. Although SA equities are cheap, like I've explained, and like you've seen in the previous chart, there's still business and macroeconomic variables that actually a little bit concerning to us, and that's why we won't be fully invested in SA equities. We're sitting at about 40% for our balanced portfolio. It's the same with SA property, slightly underweight. We do like bonds and we do like income in South Africa. Why? Because interest rates are high. So getting a nice certainty of income from these asset classes. Offshore equities, we're slightly overweight, and that is not because we overly invested into the US, but we slightly allocated into emerging markets and to China. And that's what brings this dot from being rather neutral to slightly overweight. We do like offshore bonds. Again, it's a certainty of income offshore, and then cash in the offshore markets, we are neutral. I just came to my last slide. I just want to maybe mention the type of portfolios that's available to you through the NMG advisors. And how to read this table is that on the far left is your investor objective, what you want to achieve. This is the type of portfolio that we've got that we manage for the NMG advisors. And this is just the strategic allocation to SA equities. Now, remember the balance fund that I just shown. So that's that 46%. So strategically, so we've got portfolios that are strategically got 0 SA equities, 20% SA equities, 46 like I've shown, 26% locally, nothing locally, and then 100% locally. And then this is the strategic allocation to offshore equities again. So if you think of the balanced portfolio that I've just shown, which was 22%. Here we are. So we've got portfolios, again, income orientated, got no offshore equity. Our much more stable portfolios got 16% strategically in the balanced one that I managed. Then we've got one that's got 46% offshore equity, one that's 75% equity in offshore, obviously our SA equity, which doesn't have any equity or SA offshore equity at all. And then lastly is, again, ties up to how much should I take offshore, and we cater for a variety of needs and type of investors and the amounts you want to take offshore. So again, our income portfolios, it's got basically nothing strategically offshore normally. Our stable type of portfolios has got about 25%. And remember, this amount can be adjusted downwards or slightly upwards, depending on the valuations that I've mentioned, also macroeconomic business cycle and the market cycles we are currently experiencing. Our balanced portfolio that I've shown just in the previous slides got about 29% strategically, but again, can go that way. And then we've got one that's got 54% strategically with, again, the leeway. And then we've got one which is basically only offshore. By mandate, it should always be invested offshore. So I hope this was of value to everybody, and that everybody get an understanding of how we view markets, how we implement these market valuations into our portfolio. So thank you so much for the opportunity.
Thank you, JB. Yeah, just for anyone on the call, if you want to pop questions, I will manage the webinar chat and the Q&A. So if there are any questions for JB as well as for our next speaker, Yaku, we can definitely, I'll facilitate that process. So yeah, you guys are up for a real treat with Yaku. The previous time Yaku spoke to some of our financial planners in NMG, it was quite a vibrant conversation, and there's always there are some financial planners out there that promote going everything offshore, doing everything offshore, leave the country, stay out of the country. We're obviously not like that, but it's important. It's also important to know that South Africa is 0.7% of the world economy, and to have all your assets in South Africa doesn't make sense. And then, especially when you're going to retirement, it's important to have some of your assets offshore. But then the question is how much, because you might need some of that money coming back, and there's rand dollar volatility and euro volatility. So there's a lot of factors to keep in mind. But Yaku, thank you for your time. And yeah, I want to hand over to you. I will manage the Q&A, and you can go for it.
Thank you. Thank you very much. Good morning, everybody. It's good to be here. I'm going to try and see if I can share the screen quickly, and then we can start straight into the presentation. I think the previous speaker spoke a bit about the investment markets, and I've got to admit, the last 5-6 years, from even just before COVID, has been some of the most tumultuous investment periods that I've experienced in my career, which started in the investment markets in 1997. So it's definitely been a fascinating ride, and there are many subtopics and themes that I think people would like to discuss and that they find interesting. The topic that I've picked, or I was asked to talk to you about today, is one that it's about a product, a very specific product that is very popular in South Africa and increasingly popular globally as well for pensioners, and that is called, in South Africa, it's called a living annuity. In overseas markets, it's sometimes called a drawdown annuity, and it's a very flexible pension product that has caused a lot of conversation between investors and financial advisors about many aspects of the product. So what I'm going to share with you today are some thoughts that come from some research work that we've done at 91. We're a fund management business. We're based in London as well as in Cape Town, and we do a lot of research work on helping advisors and clients understand their own investment needs and strategies better, and understand the requirements of what your portfolio should deliver depending on what the need is of the investor. And so we've done a fair amount of research work in the space of living annuities themselves. And so today I thought we would cover just a couple of basics. I realize that not everybody on the call would be familiar with what a living annuity is. So I'm literally going to spend like 2 or 3 minutes just positioning the product and what it is used for. Then we're going to talk a little bit about the meat and potatoes of having a living annuity and running it successfully. So what are the key risks that you need to manage if you are someone who owns a living annuity product, and how do you manage those? And then one of the themes that's incredibly popular, as JB mentioned earlier, is this question that advisors increasingly face from clients today: how much of my money in my various investment products should I put into offshore investments, and how much should I invest locally? So we're going to look at the subset of that question as it applies to a living annuity specifically, and maybe give you some high-level rules of thumb to help you navigate those questions. So let's start first off with, just for people who are not completely familiar with a living annuity because you don't own one, what is it really? Well, the simplistic way to explain this is, if you think about your journey towards retirement as a person, it starts off when you have a job, you're employed, and you contribute for a number of years to a retirement fund. That could be a retirement annuity, could be a company pension fund, or an umbrella fund. There's a whole host of different products that are all approved in South Africa as retirement funds. And so you're contributing to this retirement fund, hopefully from really early on in your life, from in your 20s, actually, ideally, you should be making a contribution to a retirement fund. You've been diligently doing this for your working career. You reach age 60 or 65, you decide it's time to take it easier. You retire from your job, and then the money that you saved over the previous 30 or 40 years, which is normally quite a substantial amount of money for most people. If you've saved enough for retirement, it should be more than 5 or 6 or 7 million rands for most people. That total amount of money at your retirement date is then invested in this living annuity, or the general word is a pension annuity, because you're getting a pension. A living annuity is just a type of pension that's got very specific product characteristics. You get different types of pension annuities. I'm not going to talk about the other ones. We're just going to talk today about the living annuity version. And the job of that living annuity is to take the money that you've saved up over your entire working career and to now pay you an income to live off. As you are now a retired person, you're probably no longer working full time. So you need to supplement the income that you used to get from your job, needs to be paid for from your pension. And so this product takes over the role of being your pension income until the day that you and or your spouse pass away. So that, in short, is where a living annuity fits in. So the people who are on this call today, who are already retired and who are age 65 or older, are probably already owning one of these products, especially if you're an NMG client. And those of you who are younger are probably still on the left-hand side here in the retirement funds. You will be in a living annuity at some point. So it's still useful to get to grips with some of the requirements for a successful living annuity. So that in short is the positioning of the product. What are the specifics of the living annuity? So if we kind of dive into, if you own one of these products, the 5 issues that you need to be aware of and maybe monitor from time to time with your advisor. The first risk that you need to be mindful of if you own a pension annuity, specifically a living annuity, is the risk of living too long. So you get other types of pension annuities where a life company or an insurance company will take your money and they will guarantee to pay you an income until the day that you die. So you don't take the risk of living too long or too short. You pass that risk to the life insurance company. In the case of a living annuity, however, it's much more flexible. You are taking the risk of living longer than your money is going to last. And therefore, it's critical that if you own a living annuity, that you and the advisor manage the withdrawals that you're making on a monthly basis to make sure that you're not drawing too much and that the annuity runs out before you die. And we'll look in a moment at what that means in practice. The second risk that you've got to be wary of is inflation. So your portfolio and your annuity product needs to be able to give you an increased income every year to match the impact of inflation. Now, for many years in the last 15 or 20 years in South Africa, I think inflation has been around the 6% level, sometimes even less than that. And I think we've become almost relaxed about inflation in South Africa. So the recent experience since COVID with the global inflationary spike, where all of a sudden we have inflation of 7 and 8 and 9%, I think has woken a lot of people up to remember that inflation can be a substantial long-term risk, and that inflation rarely stays at low levels like 4 or 5% for 50 years. So in most pensioners' lifetimes, you will go through a period of high inflation, and so your living annuity needs to be able to deal with that. The third risk that you need to be aware of is whether there are any guarantees, and generally in living annuities, there are not guarantees. So around investments and inflation and the risk of living too long, those risks need to be managed by the pensioner together with the advisor. And then the last one, which we'll focus on a little bit in more detail today, which is the investment risk. You need a sensible investment portfolio to drive your living annuity. Now, what does sensible mean? We'll talk about that in the rest of this presentation. So these are for people who own living annuities. I think these are the 4 points that are worth watching and keeping an eye on, and making sure that these points are on the agenda when you have your annual meeting with your financial advisor to talk about your increases in your living annuity income for the following year, and you do a bit of a portfolio review. These are the points that you want to keep in mind. So let's talk through what are the key ingredients to have a successful living annuity as a pensioner. If we expand a little bit on these points, we spoke about the longevity risk, in other words, that you live too long and you exhaust your income. That is in essence what it means. Your money runs out before you do. Now, that sounds like a fairly simple concept, but predicting that is clearly not that simple, because none of us know when we're going to die one day. And so we have to resort to the field of statistics and probabilities to help us get a bit of a grip for what is our risk of dying before our money or after our money has run out. So I want to show you a couple of interesting slides here. People often ask me, how long do people live in South Africa, but not like the general population. We have lots of statistics about, age of death and life expectancy for South Africa in general. But that's not really helpful if you're a pensioner, because as a pensioner, you belong to a very specific subset of people in a country. You've worked your entire life, you've built up capital, you've got access to better medical care. So your life expectancy will look very different from the average South African life expectancy. So what I'm showing you here is the life expectancy of South African pensioners. These are people who are parts of insurance company insured portfolios. So what you've got at the bottom is you've got your age. If we can get a pointer here, there we go. We've got your age going at the bottom. This would be your age at the moment. And then on the vertical axis, you've got how many years the statistics tell us you are likely to live still from that age. And there are two lines here. The one is the normal life expectancy, which is what we call the average age that you're going to live to. So if you're 60 today, there's a 50% chance that you'll live longer than 20 years, and there's a 50% chance that you'll live shorter than 20 years. So on average, your life expectancy is 20, but you've got a 50% chance of living longer than that. So for a living annuity plan, that's clearly not the best outcome, because you've got a 50-50 chance of being wrong. And you've got a 50% chance of running out of your money before you run out of life. And so what we look at is what we call the 90th percentile. So this is basically saying that if you're 60 today, you've only got a 10% chance of living longer than 30 years. Now, that sounds like a probability that you can work with when you're planning an income draw. And so that's the number that we think you should be using with your advisor in your projections of your living annuity. Is if you're age 60, you must use 30 as your planning horizon to be sure that the chance that your money will run out is reasonably small. And you'll see, obviously, it goes all the way down. If you're 70, your life expectancy, you've only got a 10% chance of living longer than another 24 or 23 years. And actually, strangely enough, if you go down this blue line all the way down, most retirement pensioners should plan in your financial plan for how long you will need to have money to live until your early 90s. That's my rule of thumb that I tell people is you're probably not going to live until your early 90s, but for your pension plan, you need to plan as if you are going to live until your early 90s. So that is how long people live in South Africa after they've retired, and how to factor that into your pension plan and into your calculations. The second question is, okay, what does that mean in terms of what my maximum drawdowns can be? And so I'm just going to show you a simple graph here. So this shows you what percentage of your portfolio you can draw as an income every year, depending on what age you are. So again, we've got the age of the investor at the bottom. Let's take age 60, which is quite simple, right at the start on the left. And our model suggests that a safe income level for a 60-year-old is in the region of about 5%. You can go a little bit over. I mean, these things are not lines in the sand. These are obviously all probabilities. So, but you wouldn't want to venture too far away from the 5% level and, for example, operate at age 60 here on a draw of 7 or 8%. The only time that this makes sense is if you've got other money as well. So you've got maybe a portfolio of properties that is giving you a rental income, then you can afford to draw more from your living annuity. But if this annuity is the only money that you've got left to live off for the rest of your life, the further you move away from 5%, the more substantial the risk becomes that your money will run out before you pass away. And you can see that it's 5% almost all the way to age 70. And from age 70, it picks up a little bit. And then from age 80, it starts rising quite a lot. So if you're age 80, you can draw a lot more from your living annuity because clearly you're not going to live that long. But when you are younger, and most people retire somewhere in the 60 to 70 age bracket at the bottom, the safest level of income to draw is not too far above 5% of your capital per annum. So what that means in practice is for every R1,000,000 that you have in your pension pot, don't draw more than 50,000 rands in a year, or just over 4,000 whatever rands per annum or per month. So try and draw less than 5% of the capital that's in the portfolio over the course of 12 months. So that's the first rather important piece to make sure that you don't live longer than your money does, is you need to have a safe and sensible withdrawal rate. The second piece talks to the portfolio and how you run the portfolio with your financial advisor. And really there are probably two key pieces to your investment portfolio strategy that I think you need to talk to your advisor about every year to make sure that you're in line. The first one is how much equities you've got in the portfolio. Now, this is a question that used to confuse many pensioners and even financial advisors in the past, before we did a lot of research work as 91 on this. And this graph actually comes from a research paper and a series of articles that we wrote at 91 about how to run good quality living annuities. And the first important piece here is, even though a living annuity is a product that pays you an income, the best portfolio for a living annuity is not a bank account or a money market fund. It feels wrong because you want to draw an income, so you want to have a stable product. It feels that that should be the right option. But if you run the maths and you run the statistics, the problem is that bank accounts and money markets don't beat inflation over time. They actually miserably underperform inflation. And so if you invest your living annuity in bonds and money market funds only, you've got almost 100% probability of outliving your capital. That's the unfortunate reality. So the only way to beat inflation over time consistently in any investment market is to have equities in your portfolio to provide you with proper growth. And so what this little graph merely shows you is, for different levels of income that you're drawing from your living annuity here at the bottom axis, it shows you the minimum exposure that you need to shares, offshore shares and South African shares combined. We'll talk about the split in a moment. And you can see that all living annuity portfolios should have at least 40% equities. And actually, any portfolio that draws like 4 or 5 or 6% income, which is where the bulk of pensioners are, they should be invested at 75% in shares, both domestic and internationally. So that's the first very important piece to the portfolio. Now, there's obviously a lot of behavioral matters that come in here. I mean, we all are human beings. We suffer from these fears that our money will run out after the market has fallen. And so we all have this emotional response that if we see the newspaper and we look at the stock market and we see that the JSE is down 10% because there's a COVID broke out in China, or there's a war in Ukraine and the stock markets globally all fall rapidly, we have this need to get out of our equity assets that has just fallen and invest in fixed income. And this just keeps on reminding us that that is a terrible investment strategy. Fixed income is not a quality long-term investment strategy for anybody, not even for a pensioner. If you don't have equities in your portfolio, you have a long-term growth problem in your living annuity, and the chances that you will outlive your money becomes very high if the bulk of your portfolio is in fixed income and money market assets. So that's the first piece about portfolios and how to have a sensible investment portfolio. The second piece is around offshore investments. Now, this is a very interesting discussion because the answer is to some extent that it depends. And it really depends on one major factor. If you are a South African who is busy emigrating, and we actually have a substantial number of these that we process through at 91 in our products, where we get notified that someone has a living annuity, but they've decided to immigrate to another country, and so they want to know what to do with a living annuity. I'm not going to talk about your immigration options. The key piece I want to talk about is the minute that you are no longer planning on staying in South Africa and drawing an income in South Africa with a South African cost base, what I'm going to tell you now doesn't apply. So if you plan on immigrating to the US, you need to think about how to put your portfolio as much as possible into US dollar assets. So that's the situation where a very high exposure to offshore investments would make sense if you are living already or planning on living, or you are busy transitioning to a European country or the United States or Australia or New Zealand. You need to get your pension assets to match the currency where you are moving to. So I'm not going to talk about that option any further other than to highlight it to you. So unless you are planning on immigrating, if you're staying in SA and you're going to be drawing your income here and you're going to be spending your pension income in South Africa, what I'm going to say now applies to you. And what I'm going to say is really two things. The first one is, yes, you do need offshore equity in your portfolio. This graph comes from our research work as well. It shows you that depending on the income that you're drawing here at the bottom end of the graph, it shows you the total equity assets that you need. So the sum of the two graphs, the height of the bar is how much equities you need in total in your living annuity. And the dark blue section tells you how much of that should be international equities. And you can see straight through, there's a proper blue bar for all living annuities. So the first takeaway is you must have offshore in your living annuity, even if you're a South African who's not planning on immigrating. You are staying in South Africa, you must have offshore equity. There are very good reasons why offshore equities work well for South African annuity and South African pensioners. I'm not going to dive into that detail. There are very good statistical and mathematical investment return and correlation reasons why offshore equities work well for South African living annuity investors. So for the purposes of the talk today, I just want you to take note of the fact that you must have offshore. So that's the first key message. The second question that we often get from investors is, okay, so we must have offshore, and the previous graph kind of suggests about 30%, but what if I don't want to have 30% offshore, I only want to have 10? Or no, I actually want to have a lot more than 30. I'm worried about the country. I want to put 90% of my portfolio in my living annuity portfolio in offshore international equity fund. Now, you might think that I'm silly in suggesting that there are people who do this. The largest investment fund in our living annuity product at 91, which is an investment living annuity product that's got something like 50,000 pensioners in it. The single largest fund is an offshore equity fund as I stand here today. So it tells you that there are a lot of pensioners who have put a lot of their living annuities in offshore. And it's not necessarily a bad thing, but it can be. So let's talk to this question. What happens when you've got too little or too much offshore in a living annuity portfolio? And this graph is going to illustrate for us how this works. So at the bottom axis, I've got the proportion of your portfolio in offshore equity. And on the vertical axis, I've got the probability that that strategy will fail. So that strategy won't be able to pay you your income for the rest of your life until you die. So we're going to populate this graph now with a few options. The first two options, if you're drawing a very small income of, say, 2.5%, and this often happens with people who've saved a lot for retirement and who are still working part-time. So when they retire, they actually don't need to draw a big income. They're drawing the minimum that the regulator requests from you, which is 2.5%. If you're drawing 2.5%, you can invest any amount offshore, okay? You can invest nothing. You can invest a full portfolio offshore. It's not going to make a material difference to the failure rate of your annuity. But as your income goes up, so the red line is an income of 4.5% per annum of your capital. Now you can see that all of a sudden the graph takes quite a particular shape. It has the failures here at the bottom end. So this corresponds to our earlier theory that says too little offshore or no offshore is bad. You must have some offshore. So that corresponds to that message. And then you can see here in the middle, around 25, almost to 60%, the probability of failures are basically the same. It doesn't really matter. So the message from that line is that whether you've got 25% or 55% offshore should not make a material difference on whether your annuity is successful or not. And then as you get to the very high offshore levels, we see a bit of a blip here where it suggests that maybe if you've got too much offshore, there could be some risk. Now let's look at even higher incomes. So the blue and the green line here right at the top, these represent typical living annuities that we find in South Africa, which are around 5, 5.5, 6%. Now you can see there's a very clear shape to the graph. Clearly having too little offshore is a problem because your failure rates are like 1 out of 3, which is not a great strategy. And then all the way, if you go to the right, your failure rates are again 1 in 2, 1 in 3, if you've got more than 70% of the portfolio in offshore equities. So the message is, as you can obviously deduce from this graph, is you must have offshore. Too little offshore is risky and is not an efficient way to structure your living annuity. Too much offshore can also be a risk to your portfolio. And as a matter of fact, as I said earlier, the only time we would suggest that you put 75 or 80 or 90% of your portfolio in offshore equity is if you are planning to immigrate. If you are staying in South Africa, having that high an offshore exposure is actually not a really, really good idea and could be potentially risky. And so that is the conclusion from our modeling work on the two topics of offshore. So let's, as we kind of run towards the end, I see we've got 5 minutes left, maybe we can field some questions. So the basic conclusion of my session today for you are living annuities are very popular and flexible options for people who retire in South Africa. And it gives you lots of optionality about income and who gets the benefits if you pass away. And the money isn't lost when you die. There's assets for the beneficiaries, but they require very careful ongoing management with the help of a financial advisor, because as you probably got a feel for during my talk, there are variables like income and portfolio structuring that needs to be constantly monitored. Your income levels need to be responsible, otherwise you're going to live longer than your money, and your portfolio needs to be very carefully constructed and maintained and needs to be a balanced portfolio with an exposure to a range of asset classes, which is why we always advise people when you have a living annuity to have a financial advisor to help you navigate through these 4 points. Stian, that's me. I don't know if there are any questions that's come from any of the attendees.
Sure, Jaco. Yeah, thanks. Let's see if there are any questions coming up. I'm not seeing anything. Just from my side, two things that I think it's just quickly mentioning, and maybe towards you, Jaco, when people go into retirement, going into their pension, provident fund, and even retirement annuities, Regulation 28 actually then applies, which says there are certain assets. You can't go more than 75% equities. You can't go more than X percentage offshore. There's so much bonds, so much money market, and this type of scenarios. Now, when it comes to to people going, now people are then protected sort of in their pre-retirement years.
Yeah.
But now moving out of it, they are almost, it's almost seen as equity is very, or offshore is very high risk, and offshore equity even more. Now we go and we say we can even go more into equities. Now the first question is, can a living annuity do that? Can you do that with a living annuity, or is it restricted to what that specific fund or investment asset manager's rules are? That's question A. And the question 2 is, isn't it quite daunting for people to now all of a sudden almost have the training wheels off and are able to do whatever they want?
Yeah. So two very, very good questions. So let me ask the first one, which is a factual question. So Regulation 28, as you mentioned, only applies to pre-retirement products. So the person who offers the living annuity product, which is normally in South Africa a life insurance company, when it's a life insurance company that offers the living annuity product, then there are no real restrictions on how the portfolio can be constructed. There are some restrictions on the life license in total for the amount of offshore exposure that they hold. So because a life company is an institutional investor, there's some technicalities with the Reserve Bank. So you will find often that many life companies that offer living annuities will say, you can invest the portfolio any way you want to, but you cannot have more than 40% offshore, because their license is limited to 40% offshore. But many of them won't really interfere if you go 80% equities, whereas obviously before retirement, Regulation 28 would have stopped you from putting 80% in equities. So that's the first kind of factual question. The second question, which I think is more a philosophical question from your side, and I think you're right. The fact that the living annuity product has got such flexibility, for some investors, it's probably not so great, because as you say, the training wheels are off, and if those people don't get appropriate advice, the product is not going to stop them from investing in a way that damages their long-term future. So people who are at high risk, to my mind, are people who are in living annuities and who do not use any financial advisor or don't have access to anybody else to bounce their ideas off about how to structure the product. Those are people who we normally look at very carefully, and we, as a business, we're quite concerned when we find living annuity investors like that. We think that because living annuities offer all this flexibility, the flexibility is great because it means as a financial planning tool, you can make this living annuity fit the rest of the portfolio, and you almost have no real limits about how you construct the portfolio. But the downside is people can hurt themselves if they operate in an unadvised way. And that's why we're always very keen to tell people, if you really want to have a living annuity, you should have a financial advisor to help you deal with, some of the issues that we discussed today. I think you're still muted.
Sorry, I say the other thing that comes to mind is tax.
Yeah.
Okay, so there's one question, anonymous question. I'm going to read it off the screen quickly. I'm a sickly 52-year-old female, like to retire when I'm 55. My portfolio is currently high risk. I do not have a financial advisor yet, but with your forecasting ability, should I move to lower risk just because I only have 2 years left to grow my pension, or do you think I should stay high risk to make up for the losses?
No, I mean, it's our view generally is that, the first big decision for someone who is approaching retirement is are you going to engage in a living annuity in the early stages of your retirement, or are you going to switch to some type of guaranteed annuity immediately? If you're going to be switching to some type of guaranteed annuity immediately, which if you are sick is not a good idea, because obviously you're not going to live as long as the life company is expecting, and so the rates will normally be poor value for money if you are someone who are suffering from serious health issues. Living annuities for those people are generally more popular because the assets are preserved on death for your beneficiaries. So let's say you're not choosing a guaranteed annuity, and you've already made up your mind with your financial advisor that you want to buy a living annuity. Then I would suggest that do not de-risk your living annuity or your retirement fund today. Keep the portfolio the same as it transitions from your pension fund to your living annuity. you should actually keep a high equity exposure throughout. The risks in trying to de-risk now, and then next year or 2 years' time, you transfer to the living annuity, and now you need to up risk or down risk again. The chance that you make a mistake there is very high. So, I mean, it's difficult not knowing the full details of the person who asked the question, but those would be my general rule of thumb to people are, if you know you're going to be going into a living annuity, don't make last minute changes to your portfolio, big changes in your last 1 or 2 years of your working life. Rather leave the portfolio in whatever it was at the pension fund until retirement date, and then at retirement move it into a living annuity with a fairly similar portfolio that's got 60 or 70% equity exposure. That should generally be the best strategy, irrespective of what the markets do. I don't know if JB's got any specific views on that, because it's quite a good question.
Yeah, so I think you spot on, Yaku. So if you look at what the listeners said, I think the most important fact is that whatever you want to do post-retirement should match pre-retirement. There's a lot of people that would de-risk wrongfully into a conservative or even worse into cash, only the day after retirement to enter the market again because they need a certain level of income. So my advice would be, or my suggestion would be, is sit with an advisor, do a proper planning of what you need post-retirement income-wise. And the advisor would be capable enough to match your required level of income post-retirement to an investment strategy pre-retirement that can align you, because you want that golden thread between pre and post-retirement.
Correct. Fully agree.
I agree. Yeah, I think we're on the money on time now. So the one thing that I quickly just wanted to mention, NMG has a partnership with 91, where the funds that we research and approve is on 91's list. So if any of you want to talk to a financial advisor, you're welcome to reach out to us. You can use fin planning at NMG. That's the November Mike Golf, fin planning at nmg.co.za, or pop a mail directly on the email on the attendance of this meeting or the Zoom session. And then lastly, the meeting is recorded. So if any of you want to have some more information about this or want to re-listen to this, more than welcome. And then there's all the email addresses. Thank you, Wendy. And then the two panelists, Yaku, JB, thank you very much. You guys gave us a lot to think about, and I think it was it's very, very topical to where we currently are in the market. So thank you, everybody, and thank you for joining us as well.
Thanks, everybody. Have a good week.
Thanks, everybody.